You think buying TSMC or chasing high-dividend ETFs is the peak of the Taiwan stock market? Think again. That belief is exactly why you are working harder while the real wealth grows elsewhere. You follow the crowd, you read the same headlines, and you accept the crumbs left behind by the architects of the market. You are playing a game designed for you to lose. The elite do not view the market as a place to save. They view it as a machine to be dismantled. While you wait for dividends to trickle in, they are engineering outcomes that bypass the risks you face daily. The gap between your portfolio and theirs is not about luck. It is about the specific, hidden strategies they use to double their assets while stripping away every ounce of volatility. You have been taught to chase growth, but they have mastered the art of extracting it. Today, we peel back the layers of this system. We reveal exactly how the ultra-wealthy move, how they hedge, and why your current path will never lead to the financial independence you seek. The illusion ends now. It is time to see how the real game is played. We start with number 15, advanced subscription arbitrage. When companies issue new shares, retail investors pray for a lottery win. The elite do not pray. The moment they secure an allocation, they hedge by borrowing shares or using options. If the market crashes before delivery, the retail investor loses. The wealthy player has already locked in the spread on day one, turning a gamble into a guaranteed paycheck. At number 14, we find CBAS, or convertible bond asset swaps. Instead of buying bonds, the wealthy strip the equity option from the debt. This gives them 50 times leverage for a fraction of the cost. If the stock tanks, they lose only the tiny premium. If it soars, they capture the full upside. It is a rigged game where they hold all the cards. You are betting on price movement while they are betting on the structure of the deal itself. While you hope for a bull market, they have already engineered their profit regardless of whether the ticker goes up, down, or sideways. The math is cold, calculated, and entirely inaccessible to the average account. Number 13 is the lucrative world of securities lending. While your stocks sit idle in a brokerage account, the rich lend theirs to hedge funds and institutional shorts. They collect interest fees of up to 8% annually, all while still receiving their dividends. They are essentially collecting rent on an asset that is also appreciating in value. It is a passive income stream that you are effectively donating to the market makers. At number 12, we encounter custom-structured note arbitrage. The elite bypass exchange-traded options, working directly with investment banks to trade mispriced warrants. They exploit the emotional errors of retail traders, capturing risk-free spreads through delta-neutral trading. They do not care about market direction. They only care about structural inefficiencies. While you panic sell at the bottom or chase rallies at the top, they are positioned on the other side of your order, harvesting the volatility you create. They are not predicting the future of the market. They are pricing the certainty of your mistakes. Every time you trade on impulse, you are paying a premium into their accounts. It is a system built on your lack of information, and it is operating every single second you remain unaware. Number 11 involves custom index tracking with automated tax loss harvesting. Instead of buying tax-heavy ETFs, the wealthy replicate the index in private accounts. When a stock drops, they sell it to book a loss, then immediately rebalance. These losses offset taxes from their real estate or business ventures, creating massive savings that compound over time. While you pay your full tax bill, they are using market volatility to slash their liabilities. It is not about avoiding the market. It is about using the tax code to ensure the government subsidizes their portfolio growth. At number 10, we encounter ETF discount arbitrage. When retail panic drives an ETF price below its net asset value, the wealthy step in. They buy the discounted shares, redeem them with the fund manager for the underlying assets, and sell those assets for an instant, risk-free profit. They treat market fear as a liquidity exit. They do not fear the red on the screen. They see it as a clearance sale. Every time you dump your holdings in a panic, you are liquidating assets at a discount directly into their hands. They are the ones who stay calm while you lose your nerve, and they are the ones who capture the spread when the dust settles. You feel the fear, but they calculate the margin. Number 9 brings us to private placements. When companies need quick capital, they offer restricted shares at 20% discounts to institutional investors. The wealthy buy this equity, wait out the 3-year lockup, and start the race with an automatic 20% lead over every retail investor on the open market. By the time you see the stock price, they have already banked a massive margin of safety. They do not compete with you. They compete in a separate league with a head start you can never bridge. At number 8, we see strategic single stock futures rolling. To avoid the massive income tax on dividends, the wealthy sell their physical shares right before the ex-dividend date. They replace them with futures contracts, capturing the price movement without triggering the tax hit. They keep the profit, and the tax bureau gets nothing. You pay your taxes on every dividend, providing the revenue for the state while they rotate through derivatives to keep their gains shielded. It is a rigged loop where they extract the value of the company without ever officially owning the taxable asset. They are running a different race on a track that you are not even allowed to enter. Every strategy they use turns the rules of the game into a weapon against your portfolio. Number 7 focuses on specialized infrastructure concessions. By investing in private renewable energy or power producer contracts, the elite secure long-term government-guaranteed cash flows. These assets are immune to inflation and trade wars, serving as the ultimate bunker for generational wealth. While you chase the daily fluctuations of volatile tech stocks, they are collecting payments tied to the essential energy grid. It is a locked-in yield that does not care about the direction of the broader index. At number 6, we encounter the acquisition of distressed corporate notes. When a firm faces a liquidity crisis, the wealthy buy its debt at cents on the dollar. They analyze the underlying land or patent value, positioning themselves as secured creditors. If the company fails, they seize prime assets worth far more than the debt they purchased. They do not lose money when a business collapses. They use the collapse as a mechanism to transfer ownership of real, tangible property into their own vaults. You see a bankruptcy as a loss of capital, but they see it as a clearance sale for prime real estate and intellectual property. They are not merely players in the market. They are the ones who own the floor beneath it. Every crisis is just another opportunity for them to consolidate control over the physical foundations of industry, leaving you with nothing but paper losses. We have reached the threshold. The top 5 strategies are not about picking winners. They are about fundamentally altering the mechanics of wealth ownership. You are still thinking in terms of trades, tickers, and quarterly reports, but at this altitude, the market is merely a theater for their designs. The elite have moved beyond the volatility of the exchange. They no longer rely on the unpredictable whims of public sentiment or the thin margins of standard retail investing. Instead, they have begun to control the very architecture of capital itself. They manipulate the legal structures, the tax codes, and the ownership vehicles that define the game. Every move they make from this point forward is designed to insulate them from the risks that define your existence. They are not just surviving the market. They are engineering it to function as an extension of their own balance sheets. You operate within the system, following the lines drawn by regulators and brokers, but they have stepped outside those boundaries to rewrite the rules of engagement. This is the transition from wealth creation to wealth hegemony, where the goal is no longer profit, but total structural dominance. They have built a fortress that you cannot even see, let alone breach. Prepare to witness how they consolidate their power into a permanent, untouchable state. Entering the top 5. Number 5 is the formation of a private investment holding company. The wealthy stop trading as individuals to avoid the crushing weight of progressive income taxes. They move their entire portfolios into a private corporation, effectively shifting the tax burden from their personal income to the company's balance sheet. This is where the game turns personal. They tax their profits at a significantly lower flat rate, while writing off their entire lifestyle as legitimate business expenses. The car in their garage, the international travel, the private research, even the maintenance of their homes, it all becomes a deduction. They are living large on pre-tax dollars while you work harder just to pay a higher percentage of your paycheck to the state. They've eliminated the distinction between their personal living costs and their capital ventures. While you are taxed on every dollar you earn before you even have the chance to spend it, they are spending their capital before the taxman ever gets a look at it. It is not just about having more money. It is about changing the nature of how that money is taxed. By becoming a corporation, they ensure that the state subsidizes their existence rather than depleting it. You pay for the system, but they use the system to pay for their lives. Finally, we arrive at the apex of the pyramid, the stock-backed dividend interest trust. This is the ultimate mechanism for ensuring that wealth never dies. By placing millions of shares into a specialized trust, the parents retain the right to collect all dividend income for 20 years. During this time, they live off the yield, while the principal remains legally detached from their estate. When the term expires, the entire block of shares passes to their children, completely free of estate or gift taxes. They exploit complex valuation formulas to shrink the taxable value of these assets to near zero, moving massive fortunes across generations without a single cent being claimed by the state. This is not investment. It is the construction of a permanent dynasty. While you worry about your retirement account and how to pass on a modest savings balance, they have solved the problem of mortality itself. Their wealth is not subject to the cycles of the market or the reach of the tax collector. It exists in a protected vacuum, growing, compounding, and transferring in silence. The gap is now absolute. They have reached a state where their capital is immune to the laws that govern everyone else. This is how the real game is played, and it is a game that was won long before you even realized it had begun. You have been taught that hard work, patience, and long-term savings are the path to financial freedom. That is the narrative sold to the masses to keep the gears of the economy turning. But you have just seen the alternative. The strategies discussed are not loopholes. They are the foundation upon which real wealth is built. The retail investor looks for growth. The elite look for structure. While you chase dividends and hope for market gains, they are busy stripping away the risk, deferring the taxes, and shielding their assets behind legal walls. The game is not rigged against you. The game is simply being played on a board you were never invited to see. Wealth is not created by working harder. It is created by controlling the mechanics of the system itself. You are currently paying for the lifestyle of those who have mastered these rules. Every tax you pay, every fee you incur, and every minute you spend chasing market averages is a subsidy for their dominance. Stop looking at the stock tickers and start looking at the architecture of the law. The gap between your reality and theirs is not a matter of luck or timing. It is a matter of strategy. The game is finished, the rules are set, and the winners have already walked away with the board. The only remaining question is whether you will continue to play a losing hand or finally acknowledge that the game you were sold was never intended for you to win.